In early 2020, the global economy slammed into a wall. What began as a health crisis quickly turned into one of the fastest and most violent market crashes in history. This is the story of the COVID-19 market crash and why it unfolded so differently from every other crash before it. Unlike most market crashes, COVID didn't start in banks, housing, or inflation. It started with a virus. As COVID-19 spread globally in early 2020, countries shut down travel, businesses closed almost overnight, and entire economies were frozen by government mandate. Markets suddenly faced a terrifying question. What happens if economic activity just stops? Investors had no historical playbook. No one knew how deadly the virus would be, how long lockdowns would last, or whether companies could survive with zero revenue. This uncertainty caused pure panic selling. Between February and March 2020, investors rushed to sell anything they could. Even traditionally safe assets were sold to raise cash. This wasn't careful analysis. It was fear-driven liquidation. The result was staggering. The S&P 500 fell about 34%, the Dow Jones dropped over 37%, and global markets followed in lockstep. What made this crash unique was speed. It took just over 1 month. Several of the worst trading days in history occurred within weeks. Circuit breakers, automatic trading halts, were triggered multiple times to stop the free fall. As panic peaked, something unusual happened. Investors didn't just sell stocks, they sold everything. Corporate bonds, government bonds, emerging market assets. There was a global dash for cash, especially US dollars. This briefly threatened the plumbing of the financial system itself. Then came one of the most aggressive policy responses ever seen. Central banks moved immediately and decisively. Interest rates were cut to near zero, massive asset purchase programs were launched, and liquidity was injected directly into markets. Governments followed with trillions in fiscal stimulus, direct payments to households, and emergency support for businesses. The message was clear. The system will not be allowed to fail. Once confidence returned, markets reversed sharply. Despite ongoing lockdowns, stocks began rising in late March 2020. By August, the S&P 500 had recovered all its losses, and tech stocks surged as digital demand exploded. It became the fastest crash and recovery cycle in modern market history. The disconnect shocked many. Markets were rising while the real economy was still struggling. This wasn't a structural financial failure. It was a forced pause of the global economy, followed by unprecedented support. The COVID crash taught markets several powerful lessons. Markets price expectations, not the present. Liquidity matters more than fundamentals in a panic. Policy response can change outcomes dramatically. Fear can drive prices far below long-term value, briefly. Most importantly, markets can recover long before life feels normal again. The COVID crash was a reminder that markets don't just react to numbers, they react to uncertainty, fear, and confidence. And in 2020, once fear peaked and support arrived, the rebound was historic.